Okay, this is third of 4 recordings on chapter 10. We're going to talk about the valuation of property, plant, and equipment. So companies should be recording the property, plant, and equipment at the fair value of what they gave up or the fair value of what they received, whichever is more clearly evident, whichever one you can get the best estimate of. So things like cash discounts or deferred payments or lump sum purchases, issue of stock, you have to take those into consideration. So stock, you would use the fair market value. Lump sum, you're going to be using relative fair market values. Deferred payment contracts, you would do the present value. Okay, that's it for that. Now we're going to talk about exchanges of non-monetary assets. So this is when you trade one truck for another truck. So usually it's going to be the fair value of the asset given up or the fair value of the asset received, whichever one you have a better idea about. And what we need to do is determine if there's commercial substance. Commercial substance means that future cash flows change as a result of the transaction. So it makes a difference to the cash flow of the company. So if an exchange has commercial substance, you recognize the gains and losses immediately. If there's no commercial substance and there's no cash received, you recognize your losses and you defer your gains. If it lacks commercial substance and you receive cash, you recognize the losses fully and you recognize part of the gain depending on the amount of cash received. So if the cash is more than 25% of the total fair value, you recognize 100% of the gain. But if it's 25% or lower, you recognize that portion of the gain and defer the rest of it. When there is a loss, you always recognize it immediately. This is conservatism. You should never have your assets valued on the books than more they're worth. So if there's a loss, you need to run it through. All right, here's an example. We're trading a used machine for a new machine. The exchange does have commercial substance, so we will be recognizing gains and losses. The used machine has a book value of $8,000, which is the original cost of $12,000 minus $4,000 of accumulated depreciation, and it has a fair value of $6,000. The machine they're going to be getting has a list value of $16,000, and they're going to give a trade-in allowance to them for the machine they're giving back. So there's a cash payment due. They're saying the machine that they have on the books for $8,000 is worth $9,000. So they're going to be making a payment of $7,000 in addition to giving up the machine that has a fair value of $6,000. So the new machine is going to be listed as having a cost basis of $13,000 because that's what we gave up for it. So here's how it goes. We put the new equipment on the books, which we calculated on the prior screen was $13,000. Take the accumulated depreciation for the old machine off. We are going to have a loss here because the fair value of the used machine was $6,000 and our book value was $8,000. So we will have a loss on the machine. And we have to take the old machine off the books. And we said we were going to be paying an additional $7,000. So when I do these, usually I will take the old machine off and record the cash. Then I'll put the new machine on, and then I check that my gain or loss balances the equation. If you have a gain situation and you have a commercial substance, you would recognize the full gain. So here's an example where the used trucks they're turning in have a book value of $42,000. They're saying that the fair value of those trucks is $49,000. So the company is going to give up those trucks with a fair value of $49,000 and $11,000 cash for the new truck. So the cost of the new truck is going to be $60,000. So when we go to record this, we put the new truck on the books at $60,000. We have to take off the old trucks, and we said that the accumulated depreciation was $22,000. The original cost was $64,000. So we had a book value of $42,000. And we said the fair value was 49. So 49 minus the 42 gives us a $7,000 gain, and we did make a cash payment of $11,000. Now, if the transaction lacks commercial substance and you have a gain, but no cash was received, we will defer the gain, and we do that by reducing the basis of the truck we acquire. So in the last example, we said that the fair value of the semi was $60,000, and we had a gain on the getting our old truck off the books, but we're going to defer that. So we're going to reduce the basis of the new truck to $53,000. The other way you could look at this is that the book value of the used trucks were $42,000, plus we paid $11,000, so the basis is $53,000. So we put the new truck on at 53, we take the accumulated depreciation and the old trucks off the books and show the cash, and there's no gain or loss represented. If you have a gain situation, there's a lack of commercial substance and some cash is received, we have to make an estimate of what percentage of the transaction is boot or cash. So we have to do this calculation. So the cash you receive divided by the cash plus the fair value of what you received tells you what percentage of the transaction is cash based. If it's more than 25%, you recognize all the gain. If it's less than 25%, you recognize that percentage of the gain. So we have used machinery with a book value of $60,000. The cost was $110,000. Depreciation was $50,000. So that gives us the $60,000. The fair value is $100,000. So if we take the fair value minus the book value, we've got a gain of $40,000. In addition to the machine with a fair value of $90,000, we're going to receive cash of $10,000. So if we have cash being received, and it's a no commercial substance, but there is a gain, and we have to see how much of the gain should be recognized. So the first step is to figure out what is the proportion of monetary assets in the consideration received. So $10,000 cash over the cash plus the new truck. That is equal to 10,000 over 100,000, or 10%. So 10% of the $40,000 gain will be realized, and that means that $6,000 is going to be deferred. So when we do this, the book value of the old machine was $60,000. We're assuming that we sold 6,000 of it because that was the 10%. So the basis for the new machine should be $54,000. Or the other way we can look at it is the fair value of the new machine is $90,000. We had $60,000 of gain, but we are deferring $36,000. So that gives us basis of $54,000. So we're going to show the cash received, the new machine, take the accumulated depreciation of the old machine, and the $4,000 of the gain that we're going to recognize. So this is just a summary of the different cases. You need to know what you do in each case. Here's another example. Santana is exchanging equipment used in manufacturing operations plus $2,000 of cash for similar equipment. So here is the book value of Santana's, and then we have the fair value plus the cash. And Delaware, here is Delaware's book value and the fair value. So the fair value of what's received by Santana is $15,500, and they're paying cash, so we take that out. The book value of the equipment is $28,000, accumulated depreciation $19,000, so there's a $9,000 book value. We're giving that up. So we're giving up basically $11,000, and we're receiving $15,500. So there's a gain on this transaction of $4,500. For Delaware, they're getting the $2,000 cash. they're giving up, their book value is $18,000. So they're basically receiving $2,000 plus the new machine of $13,500. So that's $15,500 that they're receiving, and they're giving up the book value of $18,000, so they have a loss of $2,500. So if the transaction has commercial substance, Santana is going to recognize the gain. This is the new equipment. They'll take the old equipment off the books and show the cash that they paid. Delaware will receive the cash. They'll have the new equipment. They'll take the old equipment off the books and they record their loss. If Santana has commercial substance, it looks like this. But if it lacks commercial substance, it changes. And what happens is you no longer will reflect this gain. And the way you take it off the books is you adjust the value of the piece of equipment they received. So by showing this at the lower value, when they're finally done with it and it's been fully depreciated, they're probably going to be able to sell it for $4,500 more than the book value they have. And that would be deferring the gain. So you defer it until you actually sell it to another party. If Delaware has commercial substance, they look like this. And if they don't have commercial substance, they still look the same, because in this case it was a loss, and losses are always recorded regardless of if the transaction has commercial substance or not. So here's two examples from the textbook, BE 1010 and 1011. So Maheta Company is trading in a welding machine, and the book value is $6,000. They're getting office equipment with a fair value of $5,000, and they're also paying cash of $3,000. So they're giving up a $6,000 book value plus $3,000 cash. So they're giving up $9,000, and they're getting $5,000 back. So there will be a loss of $4,000 in here when we record this. Cheng Company, on the other hand, has a used truck. It costs $30,000. There's $27,000 accumulated depreciation, so the book value is $3,000. They are receiving a new truck that's worth $37,000. So they're giving up the old truck that has a book value of $30,000, and they're making a cash payment of $36,000. So they're giving up $39,000. So giving up 39 and getting 37, they have a loss of 2,000. So when we look at these, we see the old equipment came in at the new equipment came in at 5,000. The old equipment is here. We also paid the cash, and the loss is the difference between what they gave up and what they received. The new truck, here's the separate one. So we're taking off the old truck and its accumulated depreciation. We're giving up cash, and then the difference between the two is going to give us the loss. Accounting for contributions, if somebody does contribute something to your company, you put it on the books at fair value and you treat it as a revenue in the period in which you received it.